Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we help you learn to invest in roughly 20 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going, bro?
I'm very good, Bryce. How are you?
Mate, can't complain. It's been a pretty hectic week, but as always, excited to be here chatting stocks with you on a Saturday. It's been a pretty important week in terms of our economic developments, and that's something we'll crack into today.
Yeah.
How's your week been?
It's been good. So, big update from the last time that we spoke. You called me Alec Reginald Renahan on our intro to our Ted Richards interview. If you haven't listened to that interview, I thought that was a really good one, so make sure you listen to that. But my folks this morning called me Reginald when they answered the phone. So, one, great that they're listening, but two, it looks like your nickname's just catching on.
That's so good. Gets me back for all the times that you've told everyone that I smoke darts, I'm addicted to gambling, I have a credit card debt.
And your name is Bruce.
And my name is Bruce.
Yeah, it's your alter ego, Bruce Lesky.
Oh, God. Well, I'm glad nicknames are catching on. So we've got Reginald and Ren, and I'll have to think of another one. So stay tuned for next week. As I said, Ren, it has been a big week. We've had some changes to interest rates. Actually, was it last week?
So when people are listening to this, it would have been last week.
Yeah.
First Tuesday of every month, the RBA meets and they make a decision on what the cash rate would be, which is short-term interest rates. And they, as you said, they made the decision to cut.
Yes, Ren. So they made the decision to cut. So in this episode, we're going to address why this is important. There's been a lot of stuff in the media about it this week, positive and negative reports. So we decided what we would do is break down what an interest rate cut means from the point of view of an investor, but also broadly speaking. So we'll discuss what happened, why it has happened. It's been a pretty historic cut, so we'll go into a bit about that, and then we'll have a look at what it means for investors from both an equities point of view, and then we'll touch a bit on cash, property, and the impact it has on the Aussie dollar. And then we'll wrap it up. Ren, you've got something hot off the press, you reckon?
No, not hot off the press, just a hot take.
Okay, hot take. And then we'll wrap it up with, I guess, what does it mean and what's to come for the latter half of this year in terms of interest rates and economic activities. So let's get stuck in, Ren.
Yeah, let's do it. So we probably have buried the lead here by not actually saying what the rate was cut to. So the interest rate was cut to 1.25%. And that was down from 1.5%, so 25 basis point cut.
Just briefly, Ren, do you want to just quickly explain to our listeners who are new to all of this, what is the RBA or the Reserve Bank of Australia's official interest rate? And we'll start with that.
So there's probably two forms of interest rates that people should understand. One is long-term interest rates that are set by the market, and that's generally longer-term government debt and company debt, so things like bonds. And then there are short-term rates, which are set by the Reserve Bank of Australia or central banks around the world. And that is the rate at which banks borrow from the central bank and lend to each other through the central bank. So the reason that these short-term interest rates are important is because that's the funding rate at which banks essentially get funded domestically. Let's not worry about overseas funding and stuff like that. And it means that if banks are borrowing at a lower rate, they can then pass that lower rate through to the customers that are borrowing from them. So in this instance, if you have a mortgage and banks can get that money at a lower rate, they can then offer you a lower rate on your mortgage. Similarly, if banks are leaving money with the central bank, they're getting paid interest on that money. and then they can then pay a higher or lower interest rate to the depositors who are leaving money with them. So your savings account, the interest rate also moves with the cash rate because that's the rate at which the banks get paid by the central bank.
Nice. And so for those that haven't studied economics, this is part of the monetary policy that the RBA and government use. So not fiscal, but this is part of monetary policy. So as you said, Ren, it dictates the value, the price at which banks can borrow money. So before we move into why it happened, I think you wanted to mention something else.
Yeah, I had a question for you.
Okay, hit me.
So a little bit of a test. The 1.25% as the RBA cash rate is the lowest it's ever been in history, and it hasn't moved for a while. So quick question for you, Bryce, before we get into it. People weren't surprised that it moved, but it is historic that it moved. When's the last time the RBA's cash rate moved?
I couldn't tell you the specific month. I'm going to have a stab. I know it was 2016, and I'm going to have a stab at October.
Oh, close. Very close.
What was it?
August 2016.
Okay, there you go.
Yeah. So it's pretty historic because, you know, we're basically 3 years later and the interest rate's moving for the first time. Now, bonus question for you, and this really sets the scene for listeners in terms of what's been happening longer term. We'll get into the history a little bit, but bonus question for you. When's the last time the RBA increased the cash rate?
Wow, that is a good question. So I'm going to have to say it. Oh, it's a tough one. Either pre-GFC or not too far after, before 2016. I'm going to say pre-GFC.
Oh, you're close. Well, no, sorry, you're not actually that close. It's the other side of the GFC. Yeah,
really?
November 2010. So
2010.
Yeah. So essentially what we've seen since November 2010 is a long-term, almost decades-long gradual decline in interest rates. So that gives listeners a sort of idea of what has been happening.
Well, let's jump into the historic aspect of this, and then we can feed into why it happened.
Yeah.
Because, as you said, it's been a period now of 3 years where it's been very stable, hasn't moved, and we would have hoped, I think, that the next rate movement would have been an increase, because that is an indication of the state of the economy. And generally speaking, if interest rates go up, then we are, likely to have a stronger economy. But that's not the case, Ren. It's, as you said, it's never been this low ever before.
No. To give some history, John Howard in 2004 in the election campaign then was boasting about the interest rates being at close to record lows and staying steady at lows. And that was the interest rate then was, I think, 5%, 5.25% in 2004. And the government were boasting about how low it was. And then what happened was it went up to about 7% when the GFC started. And in a very quick time, in like a year or something, it dropped from 7% to 3%, which I think at the time was a record low. Went slowly back up to 4.75% out of the GFC. And then since then, it has just been gradually declining since then. And it's gone from 4.75 to 1.25 in the decade since then. So really what we've seen is from the GFC to now, a really slow, long-term gradual decline. But even if you look back in history, if you go to 1990, interest rates were probably, I think, about 15%. And really what we've seen in the last 30 years is just a decline globally from high teens interest rates to single digits. In Europe and Japan, we've even seen negative interest rates where basically the government is paying you to borrow money, or essentially if you're saving your money, the government's taking money away from you. It's a real structural thing that we're witnessing globally, and Australia is experiencing it and seeing it in things like this rate cut.
So then now let's take a look at why it happened in this instance. And you can generally apply, I guess, what we're about to talk about across the board when rate cuts occur. I think we've already mentioned that a rate cut is primarily designed to stimulate the economy. It's a trigger of monetary policy.
And maybe just explain how it stimulates the economy in theory.
You kind of touched on it, Ren, briefly. You mentioned that a rate cut will make it cheaper for the banks to borrow money from the Reserve Bank, and hopefully they can and will pass on that rate of borrowing to the consumers. And that means that it becomes cheaper for consumers to borrow money from banks. And the hope is that by doing so, people will borrow more and then use that money to go out and spend on things like housing, cars, or whatever it may be. And we know that by doing that, there's flow-on effects to the rest of the economy. So if you're, looking to borrow money to renovate, then there's the flow-on effects to all of the businesses that take advantage and reap the rewards of people wanting to renovate and that sort of stuff. People are less likely to have money in savings accounts because the rates are falling, and so they might more likely to go out and invest that money elsewhere, and that has a flow-on effect to asset prices and that sort of stuff. So generally speaking, that's the idea of a rate cut. And so in this instance, that is why the Reserve Bank has cut interest rates. We're at a point now, unfortunately, that the Australian economy is faltering, I would suggest. Things like slowing household consumption. So that means household not spending as much as they used to, not consuming as much. We are increasing our savings rates, which indicates that people are a bit wary of the future and putting more money away for perhaps a time that they think they're going to need it. We have very weak wage growth. So with weak wage growth comes a less ability to consume, propensity to spend. So without wage growth, but you're not less likely to go out and spend on holidays and that sort of stuff. And also interesting, Ren, is that we've had negative GDP growth per capita for a third consecutive quarter. So that means for every person in Australia, GDP growth has been trending in a negative direction, which generally indicates we're heading towards a recession. So there's another reason, which is inflation, but we'll touch on that. Did you have anything to add for why it happened, Ren?
No, I think that's a pretty comprehensive explanation of why it's happened.
Another reason is I think we should touch on inflation, and inflation means increase in general prices across the board, a basket of goods. So the RBA has a band at which they want inflation to sit between, I think, 2 and 3%. And a rate cut is generally designed to stimulate inflation, because at the end of the day, inflation, when controlled, is a good thing. So that's another reason that that they have cut the rates. Okay, so let's have a chat about the banks, Ren. We've spoken about they're a big factor in all of this. So what was the response from the banks? And then we'll move into why it's important.
The RBA can do really whatever they want, but unless the banks pass the interest rate rise or cut onto the consumer, it really doesn't mean anything. It affects the bank's balance sheet, but in terms of stimulating the economy, not so much. So really, the expectation is that banks follow what the RBA does, because then it affects you and I and businesses that are essentially the ones that will then go and stimulate the economy. But there's nothing mandating that these banks have to follow through. So what did we see? We saw Josh Frydenberg and Scott Morrison apparently had some very stern conversations with the banks in the lead up to the RBA announcement, saying they expected a full rate cut, which, I don't know, I'm a little bit in two minds of. It's a bit heavy-handed potentially from the government, but it is what it is. Commonwealth Bank and NAB got the message. They passed on the full 25 basis points cut to mortgages especially, but I think across the board. So they got the message that Josh Frydenberg wouldn't be very happy with them if they didn't. ANZ and Westpac, not so much. Westpac cut it 20 basis points and ANZ cut it 18 basis points. And apparently that enraged Josh Frydenberg. And in response, he went public and told customers to shop around and find a better deal on their mortgages. So it's interesting because as interest rates go closer to zero, it is harder for banks. The spread between what they're making from what they're lending out, and then what they're having to pay customers who are saving with them is tightened, and that makes it harder for these banks. But anyway, what did we see? So apparently there was a 650% increase in mortgage searches via finder.com.au. So it looks like Josh Frydenberg telling people to go and shop around to get a better mortgage deal did work. And interestingly, Commonwealth Bank, so they're passing the full rate cut through, but they're delaying the mortgage reduction for 3 weeks. So I think they're passing the decrease in the interest they pay savers straight away, and they're delaying 3 weeks the reduction in the interest they charge mortgage holders. And apparently just delaying it those 3 weeks will allow them to pocket an extra $50 million just from the better spread between saving and
Scumbags.
lending. So, I mean,
What the?
yeah, it's a pretty sizable chunk of money. Like, obviously, Commonwealth Bank's huge, but still, $50 million in 3 weeks, you wouldn't say no. I think that's probably the really important thing to understand, that none of us bank directly with the central bank. None of us have our mortgages with the central bank. So when you think about rate cuts, the really important thing to understand is that we then to see either the monetary effects, either the stimulatory or the opposite effect, you do need the banks to play along. And there's a lot of people speculating that the RBA are going to cut the interest rate again later this year, and banks may not play along. They may not have the margin to play along, but that'll be an interesting one to watch, given how enraged Scott Morrison and Josh Frydenberg were this time around. If all 4 big banks don't play ball next time around, you might see 2 very red-faced government ministers.
Well, I mean, there was no talk from them at all about, the implications of a recession on their budget during the election campaign, and I'm sure they've been talking about it behind closed doors. But if we do head to a recession, as some economists predict that we will, the government response is going to be incredibly important, and it will also probably throw out a lot of their plans that they've had for the next few years from a budget point of view. So I can understand why they are enraged that banks aren't passing it on, but I can also understand the commercial reasons from a bank not to pass on a full rate. So it's an interesting equation.
It is. So we're an investing podcast here, and let's quickly talk about some of the key asset classes and how they would have affected. So do you want to kick us off with equities?
Yeah, absolutely. So equities can go both ways. So generally speaking, I think a cut in rates can push up equity markets overall. As we said, investors, those with cash are more likely to go out and borrow more money, leverage positions, take out leveraged accounts and buy more stock, and by doing so push up the price of equities. We've seen that since the end of the GFC, particularly in America with low rates, and the equity market has really taken advantage of that. So from a company-specific point of view, companies that rely on exports generally also benefit from a rate cut. Now, there's a few parts to this. The reason being that when the RBA cuts rates, it is less attractive for foreign investors to house their money in Australia because they can get probably better interest rates elsewhere. So what they do is they take their Australian dollars out and put it into another currency elsewhere. So that increases the supply of the dollar, and that pushes the value of the Australian dollar down. We'll touch a bit on that in a minute. However, a low Australian dollar is beneficial for companies that export, because it means that their products are cheaper for overseas importers of those goods. So companies that export, particularly mining companies, so Rio, BHP, Foresters, whatever it was called, I can't remember. What's his name? Anyway, those companies tend to benefit from a rate cut. Similarly, companies that have exposure to things like housing and construction, with more money out there at cheaper rates to borrow. As we mentioned, people are likely to hopefully go out and buy housing or go and do that renovation that they'd always wanted to do, and companies that are exposed to those areas will benefit. Conversely to that, I think banks, as you said, Ren, banks' profits will be hit. As you said, their margins come under pressure when there's a rate cut, and we know that banks are required to maintain a current level of fund just for emergencies. We won't go too much into that, but they will feel a squeeze on their margins, and so profits will be hurt. What about you, Ren?
So I think the interest rate changes a lot of equations in the economy, and essentially, depending on what company and what sector you're in, it'll have different effects. In a general sense, it probably, yeah, you're right. It stimulates the equity markets for two reasons. Probably one, as you said, there may be more borrowing, and that increases liquidity in the market. And then secondly, the discount rate that people use when they're valuing companies may be reduced depending on what the discount rate is. But generally, if interest rates are going down, that means the risk-free rate of return is also going down. And that will then generally mean that equity markets, that investing in companies are more attractive. You need a lower return to justify the investment if the comparison rate, the risk-free rate that you're comparing it to, is lower. Because investing is a relative business. You don't want to park your money in a good spot. You want to park it in the best spot relative to all other spots. So they're probably the two general ones. But yeah, I think, as you said, banks, property sector, REITs, all will be affected differently. Exporters, travel companies. There's a lot going on there.
Yeah, I just want to touch on travel companies just there. Not directly as a result of the rate cut itself, but as we said, the rate cuts are occurring due to a response of economic activity, and in an economy that is slowing and people are spending less on the luxury items and the needs rather than the wants rather than the needs. You need to be careful of, the Webjet and Flight Centre and even aviation and those sorts of companies, as people are less likely to spend on those as a result of economic activity.
But to confuse it further, if Australian financial products and Australian denominated bonds become less enticing and money leaves Australia, and so then investors sell Australian dollars, that lowers the Australian dollar compared to other currencies. And then what you might see is, because travelling to Australia then becomes cheaper because foreign currency can buy more Australian dollars, there might actually be more foreign tourism coming to Australia because it's cheaper. So there's a lot of second order and third order effects, I think, is the general thing. And how it plays out depends a lot on how the banks respond and then how people respond to that.
Yeah, this is what I love about economics. It's just, you can just keep going deeper and deeper, and everything is connected in some way. But let's move to another asset class, Ren. Did you want to touch on cash or property?
So I think we've sort of touched on, we've really touched on all of the three, but just to put it in headlines so people understand. So equities was that whole jumbled conversation with a lot of threads that could be pulled on. Cash is a little simpler. Cash, if you're holding cash in a bank, in a term deposit, in a savings account, whatever it is, even in a high interest saving account, you're probably going to see a lower rate going forward. So cash becomes a less and less attractive investment, and that's half the point of this. When the economy's slow, the government, the RBA, don't want you holding cash in a bank. They want you going out there and spending it. They want you buying avocado on toast and houses and, Teslas, whatever the stereotype of what we buy these days is, because then that increases employment, it increases demand, which then companies go and hire based on that demand and increases employment. And then because there's lower unemployment, workers can negotiate for higher wages, and then higher wages means that workers have more to spend, which increases inflation. So there's a real virtuous cycle that they're hoping sort of takes hold by really starting with you borrowing more and you saving less because the interest rate is lower. So if you're holding cash as interest rates are dropping, you're doing worse and worse. And then the really big risk, is if the interest rate on cash becomes lower than the inflation rate. And then you're losing money in real terms. So if you're making 1% a year on your cash, but inflation is at 2%, that means you're actually losing money because the value of your money is deteriorating more quickly than the interest you're making on it.
Something to watch out for. Luckily, I think the last inflation rate was less than 1.25%, but it's certainly the margin between the two is getting closer and closer, that's for sure.
So the next big asset class is property, which we've sort of been touching on throughout it, but do you want to wrap it up in a nice little bow?
Property is pretty straightforward. If the banks do pass on, if the banks do pass on the rate cut in full or in part, it obviously lowers the mortgage repayments for anyone who is borrowing to buy or currently has a property. So that puts more money into their pockets each month, which is intended for them to go out and spend and invigorate the economy that way. With this, as it becomes cheaper for investors to borrow money to buy investment properties, then it also can lead to inflation of house prices as money is cheaper to borrow and they can go out and buy another investment property. That doesn't take into account the current situation with the ease at which you can borrow, credit tightening, but that's for another podcast. But generally speaking, a rate cut is designed to stimulate the housing economy and also reduce the monthly burden and repayment on families and those that have borrowed to service properties. So that's it.
Yep. And then last big asset class, so we've done equities, cash, property. Last one is Australian dollar. So if you're trading currency, I sort of explained it before, but Australian investments become less attractive relative to overseas investments, and then investors move their money overseas, and that requires them to sell Australian dollars into the market and buy other currencies. That lowers the relative value of the Australian dollar and it pushes the price down. Second order effects, as we explained, could be that's better for Australian exporters, that's better for Australian tourism operators, stuff like that. But that's probably a conversation for another podcast, seeing we're 10 minutes over our 20 minutes or less already.
Yeah, so let's wrap it there, Ren. I think we'll finish with, maybe I'll finish with a comment and then you can finish with your hot...
I completely forgot about that. Yeah. Let's go.
Your hot whatever it is. Hot plate of goods. Hot take, yeah. I just want to quickly finish with what does this mean and what is to come. So I'll just quickly rattle off a few things. We've had the chief economist of AMP, Shane Oliver, he's come out to say that, he reckons there's now 25% chance of a recession in 2020. And, that, as you mentioned, there are further rate cuts expected by the market. They think the Reserve Bank will drop it another 0.25 basis points to a 1% at some point this year, so before Christmas. My only comment on this is that as we're heading to a recession, we all know that one of the biggest triggers that the Reserve Bank across all the central banks around the world use to fight a recession is interest rates. And if we are heading towards a recession with almost virtually no interest rate, 1%, then it leaves them having to come up with different ways to fight a recession. So it's going to be very much a watch this space if and when that does happen. So interesting times ahead. You want to hit us with your hot take?
Yeah, so very quickly, it seems that as we lower interest rates more and more, the effect that they're having is just less and less, to the point where it seems to be quite negligible, really. Japan, Europe, America, Australia, we're all desperately fighting for inflation, and Japan and Europe have gone to negative rates to try and get that inflation. They're literally paying people to borrow money, or paying the banks to borrow money, and they're taking money away from savers, and yet still not having the inflationary effect that we're after. It seems like there's something more at play here, and it seems like cutting Australian interest rates by 25 basis points at a time is just, I don't expect much to come out of this rate cut or the next one, really. Could be wrong. Hopefully I'm wrong for the sake of the Australian economy. But it seems like there's something structurally wrong with the way that central banks are operating around the world. And people smarter than me probably have better opinions on this. But it is just something that is becoming very clear that they used to be really powerful policy instruments, and moving interest rates moved economies. Now it seems, markets move a little bit, but it doesn't have the broader economic effect that they're wanting it to have.
Yeah, I think we could dive into this in a whole nother episode. I think it comes down to a lot with our level of productivity at the moment. I think we really need to focus on improving our level of productivity, output per hour from everyone that's working. But anyway.
Yeah, I also think the increasing levels of household debt around the world probably make a slight reduction in interest rates less of an incentive to borrow more. We're probably at a point where cost of living is so high and household debt to GDP is so high that any saving that you get on your current debt, you're just paying off cost of living pressures. It's just easing cost of living pressures rather than stimulating any further spending or further borrowing. So, I don't know. That's my uninformed hot take.
Nice. Great hot take. So, we hope that everyone now has a clearer understanding of what it means when the Reserve Bank of Australia cuts interest rates. We hope you understand why they did it, why it was historic, why it's important, and also what it can mean for you as an investor across some of the asset classes that we just spoke about. So always good to chat stocks with you, Ren, and we'll leave it there, and we'll be back next episode with a Meet the Investor, which we haven't done in a while.
Yeah, can't wait.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity